the shift from it's a currency to digital gold was interesting. But the more I think about it, the more what is beneficial about Bitcoin as an ETF investment in a portfolio is it's got the store of value properties. It's truly decentralized.
Yeah.
It's scarce, and a lot of people believe in it. It's like gold in that way, but gold doesn't move a lot. Bitcoin's volatile.
Yeah.
To me, it's gold as a teenager. I mean, it's literally 16 years old.
Yeah.
It's got attitude. It's going to steal the car. Highly volatile. Talks back to you. But that makes it hot sauce. And there is a huge market right now for hot sauce in portfolios because all these investors found these Vanguard index funds and they married them. They're like, I never need to trade again. I'm just going to marry that Vanguard index fund and wait 30 years.
Bitcoin's journey is just getting started. And if you thought its past price swings were extreme, brace yourself for what's coming next. In a recent interview with Bitfinex, Bloomberg's ETF expert Eric Balchunas shared some eye-opening insights on why Bitcoin is far from a temporary trend. Balchunas describes Bitcoin as the teenage version of gold: volatile, unpredictable, and full of potential. Unlike meme coins, Bitcoin is a decentralized, scarce asset that's reshaping the financial world in unprecedented ways. For investors seeking high-reward opportunities, Bitcoin offers a thrilling alternative to the low-yield, traditional investments that have long dominated portfolios. Forget the dull and predictable financial strategies. Balchunas urges investors to embrace Bitcoin's volatility, calling it the hot sauce that modern portfolios need. Its explosive price movements are exactly what many investors have been looking for, transforming Bitcoin from a niche experiment into a formidable wealth-building tool. Bitcoin's potential remains largely untapped, and its journey is far from over. It is positioned to make a significant impact on global finance. Before we dive into more insights from the interview, don't forget to like this video, subscribe to the channel, and turn on post notifications for more updates. Now, let's get into it.
Is 2024, the big event of the year, was the final approval of the much-awaited Bitcoin ETFs. How successful were the Bitcoin ETFs?
Yeah, it's hard to overstate how successful they were. I've been covering ETFs for 20 years. This is by far the biggest launch, most impressive. A couple stats I'll throw at you. They took in $37 billion in the first year. Net flows, that's a hard number. That's like the truth, 37 billion. We thought they'd be 10 to 15, and we were optimistic. They doubled that and then some. They have 120 billion in assets. That's as much as gold ETFs have already. We thought it would take 4 years to get to gold. So they're already there. And IBIT in particular is massive. It got to $50 billion in 227 days. The next fastest ETF in history was 1,300 days. So less than a year versus 4 years. It's insane, right? So clearly huge hit. Why was it a hit? Everybody's been waiting for it for 11 years. It's cheap, 20 basis points, some of them even lower. Liquid, and big brand names like BlackRock and Fidelity. So the regular investors of the world are like, after SBF and all that, they got like some legitimacy. And then now it's safe. Larry Fink says it's okay. It's cheap. It's liquid. It's got BlackRock. I can't get fired. That is a powerful combination for America's advisors. And we're seeing that in the flows.
So if 2024 was the year of the ETF, I think the hope is that 2025, Bitcoins are like just hopeless optimists, right? So 2025, we're hoping for more sovereign adoption of Bitcoin. We're coming to you from El Salvador, which of course was the first country to adopt Bitcoin as its sovereign currency. Maybe some changes, some bumps in the road for that. But what do you see for the US, and what do you make of the Trump administration's strategy so far? Because the strategy really looks like a mixed bag. I think from a Bitcoiner's perspective, there's some things that I think are, that we like the end of choke point 2.0, repeal of SAB 121. But there's some other kind of head scratching things like the president and the first lady issuing meme coins.
Yeah.
So what do you make of the strategy so far, and where do you see it going?
Yeah, first of all, I generally think Bitcoin was at 25,000 when BlackRock filed for the ETF. I think the ETFs were a big, if not almost all, of the push to 70. But then Trump winning pushed it to 100. And now where do you go from here? First of all, I would just say for Bitcoiners, I think sometimes they get a little spoiled. You're up 127% since the ETF launch. And it was up 80% on the anticipation of the launch.
Yeah.
So I would say, be happy. That's like 4 times any other asset in the world. Okay, so you're good. Now, looking forward, I think you have to sort of look at 2 steps forward, 1 step back. Not all the news will be great, but man, imagine if Biden won and you had Gensler, there would be no talk of any of this. So yeah, maybe you get Bitcoin in-kind creation redemptions now.
Yeah.
You get Ether staking. And with that, you'll get a couple crazy meme coins. I think you take the baby with the bathwater. And I think in Trump, it's the same way. I think generally just focus on the baby, not the bathwater. But Bitcoiners have a habit of just focusing on the negative, I think, sometimes. And I think, generally speaking, you've got the president on your side. You've got a crypto czar. And then but go back to ETFs. You got Larry Fink, Fidelity, Invesco. You've got the biggest Wall Street asset managers out sending their wholesalers out talking about this story. And just relax and be patient. That would be my message.
And you mentioned the in-kind redemptions and subscriptions. I think it's subscriptions and redemptions, right? It's on both sides for the ETFs. Is that what's being considered?
Yeah, in-kind just basically means like if I wanted to create new shares of IBIT, anybody can bring Bitcoin to BlackRock and get shares of IBIT. It's like an exchange. Before, you had to give BlackRock cash. Why did the SEC do that? They thought they didn't want Bitcoin source that might be like laundered Bitcoin or sketchy, and that's why they wanted cash only. But in-kind, I won't go into the wonky details, but when you do in-kind, it helps just keep spreads tighter, cheaper, and percent premiums tighter. It's just a slightly more cost-efficient, better deal for the end investor.
So what do you think the impact will be on the market? Do you think that'll drive more liquidity, more inflows into? Yeah,
because there'll be more places to get it, more competition. Look, when you have an ETF and it tracks whatever your thing is, you unleash the biggest, richest, smartest market makers. Because anybody in the market who's bidding up IBIT, right, it's trading on all these exchanges. A market maker is like a dealer, right? It's got to have shares of IBIT if it wants to be in the market. So it has to know how to get IBIT, how to arbitrage it, and it's going to only deal with legitimate actors. It's going to compete the two sources against each other so the costs come down. So when you unleash all of this power of these liquidity providers, it helps. It helps. I was at the SEC to one of their conferences, and I said directly to them about 3 years ago, you guys should use the ETF as a regulatory helper. Because when you unleash all these markets, they're not going to deal with sketchy people. And they're going to bring the cost down. They're going to do a lot of the cleaning up of the quote Wild West that you want to do. In the end, that's exactly what happened. Now Gensler's taking credit for launching the ETFs. And so that's the benefit. And in-kind just helps unleash that a little.
Yeah, I wonder if if the in-kind part could also be a transition for people doing, I know there's regulatory and mandate restrictions towards funds holding their own Bitcoin, but I think ideally from a Bitcoiner perspective, you'd like everybody holding their own assets with their own keys. And I think the investment kind of thesis from Wall Street is purely digital gold right now. I don't think anyone's considering peer-to-peer electronic cash or censorship resistance or anything like that. So maybe that's a transitionary step into getting people more on board with the Bitcoin kind of ethos.
Yeah, look, the shift from it's a currency to digital gold was interesting. But the more I think about it, the more what is beneficial about Bitcoin as an ETF investment in a portfolio is it's got the store of value properties. It's truly decentralized. It's scarce, and a lot of people believe in it. It's like gold in that way, but gold doesn't move a lot. Bitcoin's volatile. To me, it's gold as a teenager. I mean, it's literally 16 years old. It's got attitude. It's going to steal the car. Highly volatile. Talks back to you. But that makes it hot sauce. And there is a huge market right now for hot sauce in portfolios because all these investors found these Vanguard index funds and they married them. They're like, I never need to trade again. I'm just going to marry that Vanguard index fund and wait 30 years. Well, they like that, but they're itchy. And so they have a little bucket for speculation. Gold doesn't really fit in that bucket. Bitcoin does. So in my opinion, Bitcoin kind of is a twofer. And that's why I think it's taking off so much in the ETF.
According to Eric Balchunas, the approval of Bitcoin ETFs in 2024 was a groundbreaking milestone, and their success exceeded all expectations. In their first year alone, these ETFs saw net inflows of $37 billion far beyond initial projections. Balchunas credits this massive adoption to the ETF's accessibility, liquidity, and backing from major institutions like Fidelity and BlackRock. He emphasizes Bitcoin's role as a decentralized, limited, and widely accepted store of value, making it an attractive investment. Comparing Bitcoin to gold in its early years, he highlights its volatility and unique characteristics. Balchunas also draws an analogy to hot sauce, explaining that Bitcoin's high-risk nature appeals to investors who seek speculative opportunities. Let's take a closer look at more insights from his discussion.
Like, what do you make of the idea of this national digital asset stockpile?
Yeah, so I just think long term, it is a store of value. It's going to settle down. All this institutional money is going to settle the volatility down. But I think if the volatility scares a couple people away, it's also bringing in people. So it's maybe a wash. So I wouldn't look at the volatility as bad. And there's nothing you can do about it. It's volatile. And I do think that is something you have to acknowledge, that it trades like a high beta stock. In other words, if the stock market goes down, usually Bitcoin goes down a little more. And I think that's something that was a fear for me in terms of what could cause Bitcoin to go down like 40, 50%.
Yeah.
And I thought, well, if the stock market crashed, but with Trump, he loves having the stocks up.
Yeah.
And he loves a good stock market. So I think it's almost like a Trump put now instead of a Fed put in terms of stocks probably going to be okay. That's good for Bitcoin. So I do think the idea of using it as a reserve is smart. And honestly, let's say it goes up 100%. Damn, that's even better than a reserve.
Yeah.
And so.
Well, that's what's happened in El Salvador.
That's exactly. So I just think if I'm a corporation or the government, I am having to have a real conversation with myself that this is volatile. It's had 70% drawdowns and stuff. And you have to acknowledge that. So just like a boomer buying the ETF is not putting 100% in, they're putting 1 or 2%. Their nest egg is in S&P 500.
Yeah. I mean, that's how you handle volatility, is with positioning, right?
Yeah.
As you just make positions smaller.
Yeah, so overall, your whole budget or your whole assets, this isn't going to like totally destroy you if it goes down 50%.
Yeah. All right, I want to shift gears to security tokens because I suspect we might have a slight disagreement here. So we had comments recently from BlackRock, and they're all of a sudden they've switched from being kind of a villain to a hero, right? They're very pro Bitcoin. Larry Fink seems very pro security tokenization. He had comments that he wants to push the SEC to be faster on allowing tokenization for equities and bonds, and you had some comments on that. Could you maybe share what your thoughts are there?
Yeah, so I mean, look, Larry Fink is the head of the biggest asset manager in the world.
Yeah.
So everything he says has a lot of weight. That said, my thing with tokenization, I think where there's friction, I think tokenization will help. Money market funds are a little painful. Real world assets, private equity, art, I could see that stuff being tokenized because as a real estate investor, it's not easy. But like tokenizing stocks and bonds, it might help BlackRock save a little money in the back office.
Yeah.
But ultimately, for the end investor, I can go on my phone right now,
Yeah.
fire up Schwab, hit IVV,
Yeah.
hit buy, and I own the S&P 500, the world's greatest stock market, in like 3 seconds for no fee and no friction. It's tough to disrupt that. So part of what I've been skeptical about anything coming along trying to disrupt the ETF is, how does it make that easier or cheaper for the end consumer? So the answer is, well, it might save BlackRock a little money.
Yeah.
And
Well, I think that's what their angle is.
yeah, and maybe, but I don't see a retail investor moving unless you make it worth their while. Now, you come with me and say, here's a token for private equity, or I don't know, art, something that I can't really buy, wine, baseball cards, I don't know. I could see like, okay, I could add that token into my, yeah. So that's my presentation today, is to explain to people that ETFs are just as disruptive as Bitcoin.
Yeah.
They are a disruptive power couple. And so ETFs are so disruptive because they're so good. They're fast, good, and cheap all at once. They're like Amazon. They're very potent. So tokens, I think, have to respect that as they go in. And I talk to different token people, and some are like, tokens are the end game, it's all good. And then others are like, well, we're going to win some battles, may not win the whole war, but here, it could make sense. I'm kind of middle of the road, but I'm got my ears open because I run an ETF analyst team, and I don't know if we have to change our name to token analyst, we'll see.
Yeah, but I think there are some major friction points, right? Like if you look at how Bitcoin trades on Bitfinex, for example, it's 24/7, it's 365, it's real-time settlement. And I think traders and portfolio managers, like they would kill to have that, right? So for example, we have, if Trump wants to sanction Taiwan. I'm based in Taiwan. Anyone listening in the Trump administration, bad idea. Not sanction, sorry, tariff Taiwan. Don't do that. People want to trade TSMC, they can't, right? So they have to trade something else. So typically what they're doing now is they're selling Bitcoin. But I think if you can have, so I look at one of the big opportunities for tokenized public equity as like an ADR or GDR analog.
Yeah.
Right?
Well, the tricky part to all this is that the ETFs come with all this regulatory safeguards. And I'm not sure how tokens get through that. I mean, that's a big question. The other question is, the reason there are regulatory safeguards is that if you're on the blockchain, you're totally decentralized. It's like, well, who do you call if there's a problem?
Yeah.
I think for a mainstream advisor and like somebody who's got a lot of money and worried about losing it, those things matter. The anti-fragility of having all those back office people, it actually makes the system pretty robust if it is a little archaic.
Yeah.
And so when we have these sell-offs, somebody can call the administrator, call the custodian. This checks and balances is actually beneficial. In fact, you can't get an ETF through unless you tell the SEC, we've got a custodian, an administrator. They need all this. I'm not sure how tokens are going to check that box. So I get it.
I think they won't.
Yeah.
What I mean is you don't want to do that. We want to streamline the system. And this is my criticism of kind
Yeah,
of like
but then it's like, well,
Yeah.
Part of the reason the Bitcoin ETF was so powerful
Yeah.
is that it did have the SEC stamp of approval.
Yeah.
That is major for the big chunk of middle America advisor types.
Yeah, no, I know that product was successful on a lot of metrics, and it made number go up, which is a good thing. Everyone's happy about that. But I do find it slightly disappointing that Wall Street had to have Bitcoin wrapped in a security and completely spoon-fed to them before they could accept it.
Well, I will say this, that if you think about a regular person, they're not into the mission.
Yeah.
They just want something cool in the portfolio and they want to cure future FOMO. They don't want to kick themselves that goes to $1 million.
Yeah.
So they don't want to deal with the wallet. And
Sure.
And I was like reading, somebody was like in the LA fires, somebody lost their phrase.
Yeah.
And I was like, an ETF fixes this. And I got obviously blown up by the Bitcoin people, but it kind of true. Like, you outsource this for a purpose. I also don't want to track the 500 stocks in the S&P 500. I'd rather buy SPY and outsource it to State Street. People who best of VCs want, no, they want to outsource everything. It's a lazy move.
Yeah.
But that's the whole point.
Sure. Yeah. Well, the other thing I would say too is that you mentioned decentralization. I actually don't think the tokenized securities can be decentralized. I think it needs to trade on a centralized platform like Bitfinex Securities, because you have a regulator. You need to know who your shareholders are. You need to know who the investors are. You need to have a whitelist, right? Because you need to make sure that from our perspective, we need to make sure that there's no American investors on the product.
Yeah.
You need to make sure that it can't go to Iran or wherever. So you need those kind of things. So I wanted to tell you about one issuance that we did and just kind of like get your feedback on that, called the Blockstream mining note. So it raised $50 million over 8 tranches. It was tokenized on the Liquid network. There's a whitelisted ecosystem. Once you're in that whitelisted ecosystem, you can pull your tokens off the platform because you're in the whitelist. You can self-custody them. We can trade them peer-to-peer, where you can ping them to another exchange for arbitrage, right? And if you're on the list, we had people trade, had an ISIN, so it was a proper security.
Yeah.
And people were trading it in a Telegram chat, back and forth. So, what's your...
But in this scenario, you need your own wallet, right?
You need
an address.
You need an address, but you can also keep it on the exchange, as you see fit.
So right there, I think you're onto something. And I see a market growing for people who want to do that. Look, mutual fund people who are 80 years old, Vanguard's having this problem now. They're trying to move them to get a brokerage account.
Yeah.
Because you used to just buy a Vanguard mutual fund from their website.
Sure.
Or you call them back in the day.
Yeah.
So they don't know what a brokerage account is. It's like a 75-year-old.
Yeah.
So there's an interesting thing going on where ETF issuers trying to move people to brokerage accounts so they can use them. Maybe we'll find tokens are trying to move ETF people to get their own addresses. So I'm not saying no, but to do all of this is a big lift. It takes a lot of energy, but at the end of the day, it's going to take someone going to a barbecue and saying, oh, you still use an ETF? I was able to do this, this, and that with a token. It's way easier and cheaper. And I think that's where I don't see people. I see maybe the 1 in 100, sort of like younger person who's like onto this. They might talk about it.
Or do you mean individual investors?
I think individual investors.
Yeah.
Because advisors generally, they don't lead so much. They want to hear it from their clients. Like, hey, I want an ETF. It's like, I want my MTV back in the day.
Yeah.
A lot of stuff that happens usually is driven by the grassroots. And, people who were into active mutual funds, it used to be, oh, I'm in the best active mutual fund, 5-star at the barbecue. And then it came in, it's like, oh, I'm actually in the cheaper Vanguard fund. This is saving me so much money. Oh, really? And that's how change happens, in my opinion. It's not like, and so you need, those younger people are getting older though, and they're going to get,
demographic.
It'll just take a while. But how much does it take over the existing infrastructure? Remember, ETFs still only have 25% of the assets what mutual funds have.
Yeah.
So ETFs are still in inning 4 of killing those.
Yeah.
And so tokens might be where ETFs were in like 1996 maybe. So I try to acknowledge that it takes 10, 20 years sometimes for this stuff to reach a tipping point.
With Bitcoin's growing status as a long-term store of value, Balchunas believes that the idea of establishing a national digital asset reserve is worth serious consideration. While he acknowledges Bitcoin's volatility, he also predicts that institutional investments will eventually stabilize it. He compares Bitcoin's market behavior to that of high beta stocks, meaning it tends to experience sharper price movements than the broader market. However, he notes that volatility isn't necessarily a drawback. It can deter some investors while attracting others who thrive on market fluctuations. As Bitcoin's adoption increases, its potential use as a reserve asset becomes even more compelling. The SEC's approval of Bitcoin ETFs has been a game changer, providing investors with a regulated way to gain exposure to Bitcoin without the need to hold the asset directly. Despite the rising interest in tokenization, Balchunas is skeptical about its immediate impact on the ETF market. In his view, ETFs have already revolutionized investing by offering a fast, cost-effective, and transparent method of accessing various asset classes. While tokenization may provide benefits such as increased efficiency and lower costs, Balchunas believes that matching ETFs in terms of investor security and regulatory compliance will be a challenge. He points out that ETFs currently account for only 25% of the assets in mutual funds, indicating the existing dominance of the traditional ETF infrastructure. Just as ETFs took decades to reach their current status, he suggests that tokenization may still be in its early stages, similar to ETFs in the 1990s. Balchunas also highlights the immense financial power of the United States, which holds a significant portion of global wealth. The US stock market alone represents approximately 65% of global market capitalization. Disrupting this established financial ecosystem will be a major challenge. However, in countries facing high inflation, Bitcoin's role as a hedge against economic instability makes it an increasingly attractive option for reserve assets. Do you think tokenization has the potential to disrupt the ETF industry, or will ETFs remain the dominant investment tool? Share your thoughts in the comments, like this video, and don't forget to subscribe for more insights.